special guest this morning, Saurabh Mukherjea, to talk about the market. Saurabh, it's great to have you in the show. A very, very happy and prosperous 2019 to you and your team.
Thank you. Thank you.
And, you know, with that wish, one can only hope that...
Same to you and your viewers.
Thank you very much. One can only hope that, you know, the happiness and the positivity translates into the market performance as well. It's not been a bad year for India, you know, 2018, even though the mid-caps gave us a rude surprise on the downside.
Yeah.
But do you think that despite the election risk, that 2019 can be rewarding?
I think, as I've been saying for the last 12 months, I think the Indian market still remains overvalued in totality. 9,500 is roughly where I think the Nifty should be. Now, whether it will get to fair value or not is a different matter. If you ask me, this will again be a year for stock picking. It's difficult to see why there will be a broad-based rally in the market. I know everybody will obsess endlessly about elections, but as I've said before, I'm not so sure politics really has that much of a bearing on our stock market as people think it has. So it will be a year of stock picking, and specific segments which I think look very interesting from making money continue to be exporters who benefit from a weaker currency, private sector banks who benefit from the slide in the NBFC's fortunes, and more generally the consumption story, especially small ticket consumption where you're not having to borrow money to buy the product. So there will be pockets where you can make money, but I'm not so sure that the Nifty as a whole will bring you that much joy in the next 12 months.
That you are bullish on exporters because of weak currency. Some could counter argue that will the currency really remain weak, because all data points are indicating that the US economy will slow down in 2019 and the dollar strength is unlikely to maintain. So purely that currency arbitrage, which worked very well for IT companies and pharma companies in 2019, that big tailwind may not be a substantial part, will not be a trigger for 2019.
So Nikunj, two parts to it. One is that we know on a factual basis now that a year ago we were at say 60, 63, 64 on the dollar. We are now around 70. Most of the IT services companies fully hedge their currency exposure. So the last 12 months they haven't really seen the benefits because they've hedged their exposure out. The benefits of the weaker rupee only now start fructifying for the IT services firm. So my reckoning is even without any further depreciation, even if the rupee stays at 70 to the dollar, you'll start seeing the benefits of the weaker rupee now flow through, because the hedging impact meant that the last 12 months they actually hadn't seen the dollar weakness translate into better earnings. The second piece is it's relatively clear looking at the gyration in the rupee that for our exporters to be competitive, I'm not talking exporters in the broadest sense of the word, including manufactured goods exporters. For exporters to be competitive, you need around 75 to the dollar, and that obviously suggests that there is further tailwinds for the IT companies, the pharma companies, the export pack as a whole. It's very difficult to see how our current account deficit will go back to a semblance of normality without 75 to the dollar, and the fact that the FPI inflows are moderating as the cost of capital rises in America, both the bond and the equity inflows in totality, makes it even more imperative that the CAD goes back towards say 1.5% of GDP type level rather than the current levels which are closer to 2.5%. So 75 to the dollar feels like equilibrium, which suggests that there is further juice in playing the export story around IT and pharma.
Saurabh, the slowdown in the lending activity clearly has taken its toll on the auto sales as well, and one has seen that play out even for the month of December. But would you say the worst is already in the price, and would you at least start buying on dips or at least hunting within autos, maybe keep it to names like Bajaj Auto, wherein 30% of their revenue pie comes in for exports?
I think it's not just the slowdown in lending. I think it's specifically the challenges facing the NBFC sector which have hit auto very hard. The NBFCs are far more keener because of the nature of their business model. The NBFCs are far more enthusiastic financiers of trucks, cars and bikes than the typical high street banks are. And my reckoning is the NBFCs stay under the pump through this year. Whilst the worst of the ILFS scare is behind us, there's a whole bunch of reasons to believe that money will stay dear, cost of capital will stay high for the NBFCs, and market share will shift to the banks. So whilst I think the auto slowdown will abate as the year progresses, I think seeing 15%, 20% growth in truck volumes and 20% growth in car volumes is not something we should expect to see in 2019. I think that was a specific feature of the early part of 2018. We'll probably go back to high single digits growth on cars and trucks, but the high teens, early 20s numbers that we were seeing in car and truck volume growth, I think that'll be a long time coming. This is a year of, I think, high single digits growth in auto volumes rather than double digit growth.
Saurabh, you've been making a point that stick to the compounders list. So in 2019, any additions to your classic compounders list?
So Abbott Labs is a company we've been looking at quite carefully for a while. It seems to have all the classic characteristics of a great compounder: strong moats, proprietary technology, proprietary IP, superb cash flows. So it's a company we're looking at quite carefully. Perhaps we'll add it to our portfolio at some stage this year. The other element to think about is the fact that what you're seeing in large cap consistent compounders, firms like say HDFC Bank or Asian Paints and so on, I think there's a reasonable chance you can see the same phenomenon getting repeated lower down the market cap spectrum. I think you were discussing before you interviewed me, you were discussing small caps, and I think there's a good chance that well-run small caps have a very good year. Raw material price pressure, cost pressures have abated, and that typically is a great time for small cap stocks to see an improvement in operating margins. So I think well-run small cap companies will find 2019 to be a fertile year, and we're spending a fair bit of time looking for consistent compounders down the market cap spectrum, well-run small cap companies with good franchises.
Hiren Ved of Alchemy shared a lovely data with me when I was doing a year-end recording with him, and he said that Nikunj, I've looked at 1600 companies in last 10 years, and guess what, not even 100 companies have managed to scale up their business by more than 100x. So we may have this entire fascination that, okay, I'll catch the next small cap, but in reality, it's very, very difficult, isn't it?
True. So I think there's a very peculiar feature of the Indian market. So if you look at the Sensex churns by around 25 to 30% over a 10-year period. But the BSE 500 churns by almost twice as much over a 10-year period. What that suggests is it's relatively easy for a well-run small cap company to enter the BSE 500. He has a good 4-5 year run where growth is say 20-25%. He has a good 4-5 run, enters the BSE 500, and then what you see is companies really struggle. They struggle big time to get anywhere close to the Nifty. So our stock market is a play of two halves. On the one hand, you have giants like Asian Paints and HDFC Bank with formidable competitive advantages, cranking out huge shareholder returns over long periods of time, and then you have well-run small cap companies who are able to grow rapidly to a point but not beyond that, right? And in between these two extremities is a sort of whole load of mediocrity, which is basically the bulk of the BSE 500. So my job in a way is to think one of the HDFC Bank and Asian Paints, consistent compounders, great companies who can crank out superb returns over long periods of time. But on the other hand, look out for promising small companies who can have a 4, 5, 6 year run and end up dominating a small niche in the Indian economy. So I was referring to the smaller cap strategy of looking for companies who can dominate a small niche in the Indian economy. They might never be an HDFC Bank or an Asian Paints, but they'll have a 4-5 year good run, and that's what I'm trying to also discover. And I think this is a good year for that because raw material prices have abated, and that's typically a good climate for smaller companies to have a decent run.
Right. So where else within small caps, Saurabh, do you find value? You just said that there are those concentrated pockets, and you do believe that 2019 small caps will make a comeback.
So I think the other area I'm looking at quite carefully is playing a Capex recovery, but rather than trying to do it through say an L&T type of construct or buying Axis Bank shares, rather than trying to do the conventional Capex recovery, try to look for B2B companies who will benefit from a revival in the Capex construct in our country. So say, to cite an example, if I take a company like GMM Pfaudler, they make glass-lined vessels. Their vessels are used by the chemical industry, the pharma industry, and therefore if we have an economic revival, chemical demand spurts up, then GMM Pfaudler should experience a revival in top-line growth. Similarly, if you look at a company like alkyl amines, which makes aliphatic amines, again, if you have an industrial revival in our country, a dominant supplier of a niche chemical could see a good run. So trying to look for well-run small-cap companies who dominate a niche in our B2B economy, in our industrial economy, might be a more interesting way to play a potential capex recovery on the other side of the election, rather than trying to buy the sort of, the no-brainer type of stocks, which is what the typical investor will run out to do.
Okay, Saurabh, give us your sense on how you would be looking at the exporters this year. They were a big play into 2018, especially the IT stocks. How would they fare in 2019?
No, so I think IT remains a prominent part of my portfolio. I turned bullish around 17-18 months ago, and as we were just discussing in the early part of this interview, that if the currency remains 70 and perhaps goes towards 75, I think there's good reason to believe IT exporters will continue having a decent run in 2018. I would add Pharma to that list. I think a demand recovery in Pharma, a stock price recovery in Pharma is long overdue. Domestic demand has been very robust for the last 4-5 years. I think the worst of the FDA action is behind us, and if the currency stays at 70 or indeed moves towards 75, I think there's a long overdue recovery in Indian pharma stocks.
Saurabh, we have seen a massive outperformance in Nifty. That happened because TCS and to a large extent Reliance, they've done well, and they have a macro scare. Now we saw this kind of a factor which played out in 2013 when Rupee went down, crude was volatile, interest rates, they went higher. And then once the fears, they settled down, we saw a very strong rally in mid and small cap stocks, which is what you are maintaining. But the difference between 2013 and now is that valuations of mid and small cap stocks are nowhere cheap or nowhere close to where they were, let's say 4-5 years ago. So will there be a very limiting factor that, experts like you will be able to get few mid caps right, but that's only 15% of the market? What happens to AJ Prakash Associate, HCC, some of the mid-cap stocks where debt is a problem, some of the mid-cap stocks where cycle is a problem, some of the mid-cap stocks where management and demand is a problem?
Yes, so I'm glad you brought this point out. I think there's two different ways in which you can think of a small and mid-cap rally, right? The first way, the classic small and mid-cap rally in any market is typically when money becomes really cheap, cost of capital drops, everybody gets really excited, the animal spirits come out, and people start looking for exciting small and mid-cap companies, even though the fundamentals of these stocks might not be the greatest. I don't think 2019 is going to be a year for that sort of rally. I think cost of capital keeps going up in our country. Maybe we'll get the odd RBI rate hike before the election, but by and large, cost of capital, I think globally will carry on grinding up, and we too will be part of that journey, and hence difficult to see a small and mid-cap rally driven by risk appetite. But the other reason that small and mid-cap companies can most selectively have a good run is their fundamentals improve, either raw material prices abate or demand picks up a little bit, and they see operating margin expansion. On the back of operating margin expansion, you see selective small and mid-caps rallying. I think this is more the latter sort of year, not the former sort of year. I find it difficult to believe that suddenly we'll see cheap money sloshing around India and everybody will start having a punt at small and mid caps. It feels more like the latter sort of year, where well-run small and mid-cap companies have a good run on the back of better profitability, better profit margins in 2019.
Will you buy two-wheelers, Saurabh? There is right now only gloom and doom in a Hero MotoCorp or a Ayesha Motor. The general view is that economy will do well, rural recovery will pick up, but the auto dispatch numbers are not showing any kind of an evidence of great pickup, at least on the demand side. You made a point of raw materials. If they remain low, it is good for small cap stocks. But if interest rates, which is a raw material for a consumer to buy cars and two-wheelers, if that also remains low, will auto demand come back?
So I think let me answer an easier question first. I think FMCG is set for another good year. partly the demand base for FMCG is in good shape, election-oriented spending and so on. But also raw material prices abating is good news for FMCG stocks. I know valuations are elevated there, but I don't think FMCG stocks will suffer on account of rich valuations. If I had to buy a two-wheeler stock, if someone held a gun to my head and said you have to have a two-wheeler stock, I would go for Bajaj, because the export-oriented element of the Bajaj franchise puts it on a better wicket than Hero or indeed Eicher. So if I had to buy a two-wheeler stock, I would look at Bajaj. I think TVS Motors, I've said for a long time now, 5 or 6 years, the TVS Motors continues to be a company which has gone from strength to strength. Their BMW bike is shaping up pretty well. And I think TVS will continue to be an interesting stock to have. But if amongst the frontline two-wheelers, if someone held a gun to my head, I would say look at Bajaj Auto. The export franchise could be the main thing which draws investors towards them. The domestic piece on two-wheeler consumption, I think, will remain challenged as cost of money stays high in our country.
Yeah, and no wonder Bajaj Auto is the preferred one. Good having you on the show, Saurabh.